and welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? I hope you're having a good day, taking a little bit of time for yourself. It's the new year, and guess what? Guess what time it is? It's the time in which you and I and a whole host of human beings across the globe are creating for themselves and attempting to keep, yet again, the New Year's resolution, right? It's that time of year in which we tend to tell ourselves we have more resolve than ever before. Maybe it's to take better care of our health. Maybe it's to make a career change. Maybe it's to break off or develop new relationships. Maybe it's financially related. But either which way, statistically, they say that 90% of all New Year's resolutions are broken within the first month. What a sad state of affairs that is. But guess what? You've done it. I've done it. Most all of us have done it. It's just the way that it is. Well, today I want to hopefully give you a little bit of encouragement as it pertains to financial resolutions, retirement resolutions, to aspire for greatness. And not only that, but to maintain more of an open mind as you get closer and closer to retirement. You know, as a fiduciary working with literally thousands of people over the course of the last 26, 27 years, it has become very obvious to me that those that are very narrow-minded, those that are not open to suggestions, not open to other opinions, they tend to have a pretty rough time when it comes to preparing and then executing on retirement. Oftentimes, it's the ones that kind of acknowledge in and of themselves that they don't know everything and that there's a lot to learn and that there's a lot to be thoughtful of. Those are the ones that tend to succeed the most. And so maybe, just maybe, one of the resolutions that you and I can make for ourselves as we go into this year and we get closer to retirement is that we want to remain open-minded to new ideas, new approaches to things. Now, as I said before, the road is littered with all sorts of resolutions that are not kept, they're broken, and you've done it and I've done it. Most all of us have done it. But maybe this will be helpful. When it comes to setting goals, there's a process called SMART, S-M-A-R-T. And it's something that I think is quite relevant and really irrespective of what kind of goal or aspiration or resolution we set for ourselves. I think that this acronym of SMART can be a very clever and very useful thing. So let's go through this real quick. The letter S stands for specific. When you say you want a new car, I'm going to tell you from years of experience of working with professional coaches and working with clients that need to do a little bit of goal planning. When you are very generic, I want a new car, that's not sensory specific enough. And so I'm going to encourage you, if you have goals, if you have that bucket list of things that you want to do in retirement, trips you want to take, projects financially that you want to accomplish, I'm going to encourage you to write down that goal, but be extremely specific. And let's use the car as the example. I want you to not only get the make and the model, I want you to get right down to the nitty-gritty of what kind of interior is it going to have? What is it going to feel like? Is it going to be, a paddle shift, or is it going to be an automatic on the column or on the console? Everything that you can do, even down to the paint job, is going to be creating a sensory specific spot in your mind. And it's very, very important that you do this because that's what helps to create that desire. It's so vivid in your imagination that it helps you better accomplish the goal. Number 2, the letter M stands for measurable. This is something that whether you're in weight loss or you're working hard to save, making certain that you have a measurable action item, a measurable way to look at what you are accomplishing as far as progress is going to be so very important. Whether you're weighing yourself or you're taking and you're simply paying attention to the balance of the brokerage account or the savings account that you're saving and adding money to, it has to be absolutely measurable. Number 3 is the A in the acronym SMART. And this is something that I think is so very important, and that is achievable. Whatever goal, whatever resolution you have, it has to be achievable. Now, granted, there's many of us that have extremely large, hairy, audacious goals, things that are extremely bigger than life. And it's okay to have kind of that big, hairy, audacious goal. In fact, I have a number of them. But when it comes to having something very practical, something very useful as a sense of direction or a resolution that you have made for yourself, financially speaking, you want it to be achievable. If you have $0 saved and by the end of 2026 you want to have $1 million, who might argue with that logic? But is that really achievable if you only have, say, the $60,000 job? Okay, so we want to make certain that we're looking at these goals and they appear to be achievable using logic. What about the R? The R is relevant. So many times we tend to plan or make plans for things that really aren't even relevant. Or we may be focusing or taking and absolutely just stressing over something that's not even relevant, something that it doesn't even affect where we are going. So in other words, you want to save more for retirement, but you're extremely affected or impacted by the idea of taxes going up in the future. Well, the reality is that based upon what we've seen just take place in 2025 with the passage of the tax law, well, chances are that's not a relevant thing to be concerned with. It's something that's probably going to be one of your least concerns, in fact. Just the idea of being able to save what you want to save every single month to be able to someday hit that goal of so many dollars worth of savings by the time you come to retirement, that, my friend, is going to be more relevant. So then what about the T? The T stands for time bound. And what this is that time in which we have a goal. It's very specific. It's very relevant to us. It is something that we've made certain that it's measurable and it's achievable for us. But now what we're going to do is we're going to create a time frame. We are going to set a very specific date and time to say, by this particular time, this is when this will be accomplished. And I cannot tell you how important it is to set deadlines. You see, from a scientific standpoint, there's something called the Parkinson's theory that would indicate to us that as human beings, we have a very unique knack to be able to take as much time as necessary or as much time as we allot to a certain project. So let's just say that I give myself 6 months to build a bird feeder. Chances are I'm going to take all 6 months to build that bird feeder. Chances are I probably won't even do anything in the first 5.5 months of making that bird feeder. But in the last 2 weeks of my time frame, I will get busy and I will get that bird feeder built. Well, the reality is that if we're going to have any sense of urgency, we want to be able to build into our plans, our resolutions, that idea of having a time frame or time bound. So maybe this is something that is helpful to you, something that gives you maybe a bit of a process to follow that's going to give you a greater chance at success. And that's what it's really all about. We don't want to be a part of the 90% that constantly breaks our resolutions. We want to be a part of the 10% that actually accomplishes them. Now, I want to challenge your thinking. As we kind of began our program, we talked about being open-minded. And I want to ask you a question about returns. Obviously, when we first start investing, regardless of whether that is in our 20s or 30s or 40s, maybe you got a late start, hopefully not, and you just started saving in your 50s. But I want to ask this question: do returns really matter? Do they really matter? And I want you to think about that and then kind of contemplate this question as well. Can you spend a return? Can you spend a return? Now, I've kind of skirted around this issue and I've talked about it in multiple different ways. So let's just think about it this way. What is a return? Well, a return is where I have paid so many dollars for something, and whatever that something is has become more valuable. So there has been a form of appreciation that has taken place. Now, if you think about your home, for instance, if you're the normal average American, over the course of the last 5 years or so, the value of your home has come up drastically. Now, for some of you, you feel that it's gone up in value way more than what is realistic, and that could be true. But nevertheless, the value of your home is supposedly higher today than it was 5 years ago. So let me ask you the question: from year to year, when you saw the value of your home continuing to climb and go higher and higher, did that change your life? Did it really change your life? Did you go out and buy a Lamborghini? For most individuals, the answer is absolutely not. In fact, your life didn't change one iota just because the value of your home went up in value. And so let's ask this question: what would you have to do to be able to spend that appreciation? So let's say that your home 5 years ago was worth $100,000 and today it's worth $150,000. So you've got $50,000 worth of appreciation on the home. What are you going to have to do in order to be able to enjoy the $50,000 of appreciation that your home has realized? And the answer is simple. You only have one choice. You would have to do what to the home? The answer is you'd have to sell it. Now, I want you to think about that because we're coming up to our first break. And when we come back, we're going to discuss what is the difference of mindset that we have to have from the accumulation stage of our life to what will be the distribution stage of our life. It's a very important point and one that we all need to grasp and one that we have to be thoughtful of. Sit tight. We'll be right back. And welcome back to the second half of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. So if you're just joining the program, welcome to today's program. Today we're discussing financial resolutions, and we're kind of discovering that there's a multiplicity of individuals in this world that never keep their resolutions. You might be one of them. I know I've been one of those individuals. But the goal is to continue to try to create resolutions that are extremely specific. They're very measurable. They're achievable. They are relevant to us, and they're time-bound. We have set a time frame or a deadline to get these things accomplished. And before we ended the first half of the program, we discussed a question that I think is so very important, which is, when it comes to returns, do they really matter? I know that that sounds really strange coming from a financial advisor, fiduciary, but I want you to answer that question. Do returns really matter? And not only that, can you spend them? So I gave you the example, a little bit of food for thought, about your home and the value of your home appreciating. What do you have to do in order to be able to enjoy the appreciation that your home has realized? And the answer is simple. You only have one choice. If your home's gone from $100,000 to $150,000, or whatever number you want to assign to that analogy, you only have one choice. You have to sell the home. Now, here's why this matters. You see, as we get closer and closer to retirement, our minds need to be shifting in some respect from the accumulation mindset to the distribution mindset. And I know I asked you a question that was somewhat tricky, and maybe it was a little, misguided. Maybe it was a little mischievous in asking you if returns really matter. But the answer is that the return on your money is extremely important, especially in the accumulation stage of your life. Because when you're young, you're in your 20s, your 30s, your 40s, your 50s, you're investing money into that 401k, into that 403b, into that mutual fund, that index fund, that stock, whatever that thing is, real estate, you name it, with the expectation of getting a return. And why do you want the return? You want the return because you want to grow and compound your money as quickly as possible. You see, for some of you out there, you are so utterly conservative that your money is, it's not, your working capital isn't working. It's making 2%, 3%. That's not good enough. It's not even beating inflation. And so you need to be more aggressive. You need to be open-minded to be more aggressive. For some of you, all you have done is chase returns. And chasing returns has paid you greatly. You have increased the size of your portfolio, the value of your holdings, the value of your retirement savings. But you've become so absolutely enamored with returns that you've lost sight and focus of what you want from your money and what those returns are really for. You see, this is what's so important. As we get closer to retirement, we need to make that shift in our mindset from accumulation and returns to now income. Folks, I know that it sounds maybe a little strange, but as you get closer to retirement, returns really mean a lot less. Income means everything. Because if you think about the primary reason why you've worked so hard for so long to save the dollars that you have saved, you did that with the intention of being able to make that transition from that paycheck to that playcheck and be able to accomplish all of the things that you want to accomplish. Do you remember that acronym at the very beginning of today's program, SMART, where that goal is very specific? And I challenged you, if let's say one of your goals in retirement is to have a particular car, let's say that you want the Mustang or you want the Lincoln or you want the Audi, and you're being very specific about the make and the model and the color and the interior and what it's like and what it feels like and what it sounds like. You're being extremely sensory specific with that goal. Well, the reality is that we need that in all facets of our retirement. And we need to understand that what makes the world go around in a retirement, in a retired person's life is not how much they're worth, but rather it's how much income they have to spend. You see, the difference between the accumulation mindset and the income mindset is the difference between being a trader versus being a landlord. So if I can, I want to challenge you in 2026, if you're within 5 years of retirement, start treating your money, start treating your dollars, start treating your investments like a landlord. You expect out of a piece of property a return. You expect out of a piece of property a cash flow. And we're not talking taking and trading this apartment complex for another retirement or another apartment complex, but rather we're talking about taking and owning the apartment complex in order to be able to get income, to be able to get rent. And why is this important? Well, because when you think about it, if let's say the market began to decrease just as you retired, and you had not made provision for retirement income. You just simply were still maintaining, still owning, still holding the same accumulation type instruments and assets within your portfolio. The market's declining. You no longer have a income stream, and now you need to start supplementing your income with withdrawals from your retirement savings. What is Fidelity going to have to do? What is Vanguard going to have to do? What is Principal going to have to do when you call them up and you tell them that you want a systematic withdrawal every single month? In the same way, my friend, that you wouldn't be able to enjoy the appreciation of your home without selling it. The same thing is true when it comes to accumulation type assets. Whether it's the mutual fund, the index fund, the stock, if you need so many dollars and you don't have the income, you don't have the interest, you don't have the dividends to be able to produce that kind of income for you every single month, you have no other choice than to liquidate and sell your assets. Now let me ask you, could this be the reason why so many retirees today are afraid of not dying, but they're afraid of running out of money? Because they're in a position, not by their own choosing oftentimes, but because of the advice that they've received from financial advisors, to focus on the return instead of focusing on the purpose of why they're saving. You see, this is why so many retirees today are scared. They're nervous. They're concerned. They're maintaining such a very small set of retirement goals for themselves because, after all, they don't want to be disappointed. They don't want to run the risk of running out of money. I had an experience just recently with a gentleman who was a bachelor, never married, no kids, and he owned a business. He had worked really hard at this business. He had worked hard. He had saved right. He had done all the things. But now he was retired. He sold all the equipment, and he was retired. And he wanted to take a few trips. He wanted to buy a few things. He wanted to fix up a few things around the house. And he was saying, I just simply want $2,500 if I can get it from what I've worked hard to save. Now, I want you to just imagine what it would be like for this individual if all of a sudden, now that he's sold all the equipment, he no longer has his business, he's getting a meager Social Security coming in every single month. If all of a sudden, when he needed income, every single time he needed income, he had to sell something. Whether he had to sell an acre of farm ground, or he had to sell a few dozen shares of a mutual fund that he owned, if he had to sell a car out of his collection, whatever it may be, is he going to feel good about that? For you and for me, it really never feels good to have to sell anything just to get money. We've probably all been there at some point where we've had to sell something out of desperation. We have a baby on the way, and we really have this motorcycle, and we need to get rid of the motorcycle in order to be able to make provision for having that child. And then down the road, sometimes we regret selling that asset, don't we? Well, my friend, I'm going to challenge you today to change your mindset from the trader, chasing the returns, hoping, crossing your fingers and toes, hoping that the market continues to go up, to changing your mindset to that of a landlord, expecting more, expecting that every red cent of what you've worked hard to save is going to be producing interest and dividends. And can you imagine that gentleman who only wanted $2,500 when he realized if he would simply make some very small, very conservative adjustments within his own portfolio, from focusing on growth and appreciation that he cannot spend unless he sells the asset, to income production, realizing that not only could he have $2,500, but he could have 3 times that and never touch his principal. How freeing is that? How wonderful, how much of a breath of fresh air that is, to realize that you've got all the points on the board to win the game, and you can get all of the income you want and more. But you see, it makes only one thing necessary, and that's being open-minded to how you're investing, changing it from focusing of chasing the returns to focusing more so on what your money can do for you and the production of income. So again, my friends, remember, the sequence of returns is something you and I cannot control. We can't control when the market goes up. We can't control when the market goes down. But what we can control is how our money is invested. I'm Matthew Johnson. Thank you so much for listening and watching. And remember, it's up to you to make today a great day.